go. Okay, good evening. My name again is Janice Strutt, and I am on with Jara. And we are going to talk about tax benefits for families caring for a child with disabilities. Jara is with Akamai, and she's the Director of Tax Services. And she's got a great presentation for us this evening that is packed with a lot of information. So I'm going to go ahead and turn this over to her so that she can go ahead and get started. At the end, I will go ahead and open it up to questions. And if anybody has any, more than happy to open that up, and we'll just kind of go from there. And again, at the end, um, with the Q&A, after the Q&A, we will send everybody out an email with a link to the video recording of the presentation so you can view it again for reference points in the future. And then we will also send out a survey. I know that that's not everybody's favorite thing. Ours is very, very intentional because we want to make sure that we're giving you information that is helpful, gives an opportunity to gain feedback on things we could do better or differently. For example, if it's too much information, maybe we could break it into 2 webinars. If there are other topics that you'd like to learn about, and then we use that information also when we are applying for grant funding to help support this program. So any information is super helpful, positive or negative, we welcome it because we only want to do what's in, your best interest. So again, I will hand this over to Jara and let you go ahead and get started.
Well, thank you, Janice. And yeah, you got my name right. So no worries about pronunciation. Thank you, Janice, again, for reaching out to me for this presentation. And I thank you, everybody, for being here. We do have a lot to cover. And again, as Janice said, my name is Jara Rios-Rodriguez, and I am the Director of Tax Services. And I'm also a paraplanner with Akamai Investment Advisors. Tonight's session is going to cover 3 federal tax benefits that contain specific disability provisions that families often miss. And this is the dependency rules, the earned income credit, and the medical expenses deduction on Schedule A. Each has a disability-related exception or treatment that changes outcomes and sometimes by thousands of dollars annually. Tonight we have, or this evening, we have 60 minutes. Approximately 45 of those minutes are of content, and then we'll have 10 to 12 minutes for Q&A or more if needed. And you'll leave with 2 things here, which is, Janice already mentioned that you're going to get the copy of the slides, and you're going to get a copy of the recording. And also I have a working spreadsheet for everybody that attends for tracking medical expenses against the Schedule A deduction that you can use to help yourself and also, your tax preparer with tracking those deductions and also saving yourself in case of an audit. So three corners of the federal tax code shift when a child has a disability. And that is, I hope that all of you can see my
You're good.
Cursor. I'm good. Okay. So the dependency is the qualifying child age gap. Normally it's under 19 or under 24 if it's a full-time student, but this does not apply to a child who is permanently or totally disabled. There is no upper age limit for that. Adult disabled children can remain claimable as dependents indefinitely if the other 4 tests are met. Then there is the earned income credit. The same disability exception waives the EITC qualifying child age limit, and a disabled adult child can be an earned income credit qualifying child at any age, subject to some other rules. Then we have the medical deduction, the medical expense deduction, which, and the important number here is 7.5%, which is if you have unreimbursed medical care that is above that 7.5% of your AGI, that deducts on your Schedule A. And what are the things that are deductible are disability-related medical costs, which include therapy, it includes special equipment, home modifications, service animals, transportation, and these expenses often push families over the floor when ordinary medical costs would not. So again, something to remember, 7.5% of the AGI is your central number in this session. Below this, nothing deducts. Above this, every dollar of unreimbursed medical care counts. Moving on to the next slide. We have 3 objectives for this session. And one is to identify when a child with a disability qualifies as a dependent, including the cases where the standard age gap would normally disqualify them, and the cases where a qualifying relative analysis is needed instead. Then the second objective would be to apply the earned income credit age rules when disability changes the age test, and identify the remaining earned income credits requirements that disability does not waive. And the third part of the presentation is gonna have to is having to do with implementing an 8-field tracking system for medical expenses that produces for you a defensible Schedule A deduction at the end of the year. So let's go to part 1, which is dependency. So until dependency is established, none of the other benefits will apply. So the first thing that you have to tackle would be that dependency. So they are 5 qualifying child tests, a disability exception to one of them, a fallback qualifying relative category for cases that don't meet the qualifying child standard, and one specific income exclusion for disabled adult children. In order for a qualifying child to be considered a dependent, you must pass, or they must pass, all these 5 tests. Failure on any of these disqualifies the child from that qualifying child category. There is a fallback qualifying relative category, but that category has different tests that have to apply in order to be able to fall on that other categories. So in the area of relationship, it can be a son, a daughter, a stepchild, foster child placed by an authority or an authorized agency or court, a sibling, a half sibling, a step sibling, or a descendant of any of those. Grandchildren, nieces, and nephews qualify when they are descendants of qualifying relatives. An unrelated child that you are caring for does not qualify as a qualifying child. The second test, it's the age test. And the standard rule has 2 tracks. You have to be under 19 at the year end or under 24 at the year end if you're a full-time student during at least 5 months of the year. Now, this is the test that is going to, like, that disability changes the rule entirely. And we will cover that on the next slide. Then we have the residency test, which is that the child have to live with the taxpayer in the United States for more than half the year. And temporary absences count as time at home. So hospital stays, education, vacation, like business, military service, or detention in a juvenile facility. Those are temporary absences. And there is a half-year threshold that is not exactly half of the year, but 183 days, which is often a confusion. Then the next test is the support. So it's important to prove, at least in the dependency part, that the child did not provide more than half of their own support during the year. And it's not whether the parent provided most of the support, but whether the child provided half of the support. So there's a publication, and the publication is 501, that includes a worksheet, and the name of the worksheet is worksheet 2 for cases where you have to, like, you don't know if you need some calculation to figure out if they provided half of their own support. And this becomes relevant, especially when an adult child has Social Security disability benefits or wages that are contributing to their own living costs. And then the last test is that the child cannot be filing a joint return with someone else, except if they are going to claim some refund for withholding or estimated taxes. So the underline here is that all 5 tests must be met, and disability waives one of them, which is the age test, but does not waive the others. If a child is permanently and totally disabled at any time during the year, the age test is met regardless of age. So again, any age, a 30-year-old, a 45-year-old, a 60-year-old meets the permanent and total disability standard, passes the age test for dependency purposes. And this is the most consequential disability provision in the dependency rules and the most underused. So there's a common misperception that an adult child cannot be a dependent because of age, but again, that age test is waived. The other 4 tests are not waived. They still apply. So relationship is still required, met by the definition again of biological, adopted, step or foster children. Residency, more than half of the year is still required. Group homes, supported living, and assisted living facilities complicate this a little bit, but the question is whether the placement is a temporary absence or a change of residence. And all of those things depend on intent, duration, and whether the parent's home remain the child's permanent address or the dependent's permanent address. Support, that is also still required. Adult children with Social Security disability income or earned income may be providing significant support to themselves. And then that's the time when that publication 501 is going to be used, and the worksheet is going to be necessary to prove that dependency. The joint return test is also still required, but it's typically not an issue for adult children. The Internal Revenue standard for permanent and total disability lives under a section that it's the same section for the credit for the elderly and disabled uses. And that is what we're going to cover on the next slide. So what permanent and total disability means? They have 2 elements, and both of them have to be present. So the part 1 of that disability or permanent and total disability is that the individual cannot engage in any substantial gainful activity because of a physical or mental condition. Part 2 is that a physician has determined that the condition has lasted or is expected to last continuously for at least 12 months, or there is the expected result is the end of life. Now, going back to the first one, what constitutes substantial gainful activity is a term that the Social Security Administration also uses to evaluate disability claims. And the Social Security Administration sets monthly earning thresholds annually. And for 2025, and this number that I'm going to give to you is a 2025 number, is it's 1,620 per month for non-blind individuals, and 2,700 per month for blind individuals. Now for 2026, that threshold rises to 1,690 for non-blind individuals and 2,830 for blind individuals. The IRS doesn't apply those exact thresholds, but the concept of what means substantial gainful activity. In terms of that part two of the doctor or the physician determining the condition of the person, both elements of this is required. And one of the things that it's important for parents of children with that have disability is that they should keep this physician's letter on file, stating two things: that the patient cannot engage in substantial gainful activity due to specified physical and mental condition, and that the condition has lasted or it's expected to last for at least 12 months. The IRS does not require this, every year that you're going to file your return. But if the return is audited, it is helpful for you to have that, because you're going to have to produce that. So an advice is to refresh that letter periodically, like at least once a year, and particularly in conditions where prognosis might change. Now, one additional thing related to the dependency rule that impacts disabled adult children is when a child fails the qualifying child test, most often because of residency, or because of support. Then the qualifying relative category may apply. And then when it comes to the qualifying relative test, that qualifying relative test includes a gross income limit that is set annually. So for 2025, the limit was 5,200, and for 2026, that limit rises to 5,300, and that limit is adjusted each year for inflation. Modest part-time wages, even for a few hours a week, can exceed that limit and disqualify the dependent. Now, there is something that can save the dependent into being still considered this qualifying relative, and it has to do if they participate or are being paid to participate in services that are performed at what is considered sheltered workshops by when they participate in these shelter workshops, the individual, it's exclude the sorry, the income that he makes on um, that workshop is excluded from gross income. It doesn't apply. So, and what is a shelter workshop? A shelter workshop is a supervised work environment that is designed specifically for individuals with disabilities, and it's typically a nonprofit program or a structured day program that provides work experience, it provides training, and it provides rehabilitation services. Wages that are earned on that workshop are real wages, but they are excluded for this specific dependency test. Without the exclusion, a disabled adult child earning $2,000 a week, roughly $10,000 a year, would fail the qualifying relative gross income test and lose the dependent status. This exclusion preserves that dependency. And the exclusion is narrow because it applies only to the qualifying relative gross income testing. It does not exclude shelter workshop income for what we're going to discuss next, which is the earned income credit calculations. And it does not affect the substantial gain activity analysis under the permanent disability definition. So as we move into the earned income credit, the earned income credit is a refundable federal tax credit for low and moderate income working taxpayer. Refundable means that it can reduce tax liability below zero. The difference comes back as a refund. For families with qualifying children, earned income credit can exceed several $1,000s. And earned income credit uses its own qualifying child framework. The disability exception parallels the dependency rule, but applies separately. This is a bit confusing, but we'll work through it. So for the earned income credit, a qualifying child meets the age test under any of these three conditions. He or she is under 19 years. That's a straightforward case. Then path B would be under 24 at the year end and a student for at least 5 months during the year. Student includes full-time enrollment at a qualified educational institution and a full-time on-farm training. Full-time follows the school's own definition. So, and these 5 months don't have to be consecutive, and they don't need to be full months. So partial months count. Then the path C is any age if the child is permanently and totally disabled at any time during the year. And this definition is the same one that we covered on dependency, and the documentation that is required is the same. Path C is what makes earned income credit available to families with disabled adult children. A 31-year-old, for example, disabled adult child living with a working parent can be that parent's earned income credit qualifying child, provided that the remainder earned income credit tests are met. So the disability waives the age test for EIC. It waives nothing else. So the remaining earned income credit requirements still apply, and several of them disqualify families who assume that they are eligible. So these are the 6 rules of earned income credit. None are waived by the disability. Relationship are the same categories as dependency. The residency test, the qualifying child lived with a parent in the United States for more than half a year being more than 100, it's 183 days, and time spent in the U.S. military service counts as time at home, time in nursing facilities, group homes, institutional care. They all count as time as home. The child cannot be filing a joint return, except only for refund. The qualifying child must have a social security number that's valid for employment and issued by the due date of the return, including extensions. ITINs and ATINs do not qualify for earned income credit. A child without a social security number cannot be claimed as an earned income credit qualifying child, regardless of any other factor. Also, married filing separately generally cannot claim earned income credit. There is an exception to that rule, and it has to do with spouses that lived apart for the last 6 months or that are legally separated, but don't try to navigate that rule without advice. And the last of those rules is the income and investment limits. Earned income, AGI, and investment income all have annual ceilings. So earned income and AGI maximums depend on filing status and number of qualifying children. And for 2025, the investment limit was 11,950, and for 2026, that threshold rose to 12,200, and those limits adjust yearly. So for purposes of the earned income credit, you have to verify what are the thresholds, because those thresholds change every year. And those thresholds can cost you your eligibility. So one specific rule worth flagging is disability benefits received. This is important. Disability benefits received from an employer's disability retirement plan are treated as earned income for earned income purposes. until the recipient reaches a minimum retirement age. So once the recipient reaches that minimum retirement age, the same payments are treated as pension income, not earned income. Let's go to part 3 of this pillars, which is the medical expense deduction. And the dependency and the earned income credit turn on some rules. And the medical deduction turns like records. So we'll cover the floor calculation and the categories that qualify, the categories that don't, and an 8-field tracking system that produces a defensible deduction at the end of the year. So as I said before, and we can look at this example, we can look at this like line by line. So the 7.5 AGI rule is set by a statute and does not change from year to year. So the dollar figures that I am providing you here are illustrative. It's just an illustration for like a 2025 household. So, and this household has an AGI of $85,000 a year. The 7.5% of 85,000 is 6,375, and that is the floor or the threshold that the medical expenses must exceed before any portion can be deducted. So this family had a total of qualifying medical expenses that went up to $14,200. And this is a gross figure, like including every doctor visit, co-pays, prescription, therapy sessions, diagnostic tests, medical mileage, and qualifying like disability related expenses. Now they got reimbursements through HSA and insurance. And the total for those reimbursements were $2,800. Now, the 2,800 reduce the deduction dollar for dollar. This is unfortunately one figure that most of the families sometimes fail to track, and is one of the most common causes for overclaims. So what we have as a total of unreimbursed medical claims or medical expenses is $11,400. Now, what is deductible on Schedule A would be that $11,400 minus that $6,375, which equals $5,025. So the most important thing you should get from this is that the floor is kind of a gate mechanism. It's not a starting point. A family that had only paid in this same case $6,000 in medical expenses, they would be below that floor, so they cannot deduct the expenses. And the other observation would be that reimbursements of HSAs, FSAs, reduce that deduction $1 per dollar. It's $1 per dollar. Then what counts as a medical deduction, and what is a qualifying expense versus a non-qualified expense? And for this, there's another publication, which is the publication 502, that qualifies medical care. That defines what is qualifying medical care. And those are expenses for diagnosis, cure, mitigation, treatment, prevention of disease, or for purposes of that are affecting any structure of the body. So we have medical and dental professionals, we have prescription drugs or insulin. Nothing that is not prescribed can be deducted. Diagnostic services, medical equipment and medical supplies, special education when the primary purpose of that education is to address a diagnosed disability. And that school must have a program specifically designed for the condition. Like if it's a private school, but just has like a learning support for a program, but it's not specifically designed to treat the condition, that is not deductible. Except that in Madison, Wisconsin specifically, private schooling is deductible on the state, and that's interesting. It has a credit, but generally it isn't if you're out of state. Service animals are also deductible, and the costs related to that service animal, including veterinary expenses, grooming, food, modifications for medical expenses, for access, or for medical access, like ramps, widened doorways, accessible bathrooms, stair lifts. They are deductible. There are some rules that apply to it. And then transportation for medical care, nursing services, lodging costs for medical care, they're up to $50 per person per night. Medical insurance premiums that are paid with after tax dollars. And then, there is a whole list of things that don't qualify, like anything that has been reimbursed by the FSA or by an HSA, funeral expenses, or household help, unless it's a nursing type of care, any cosmetic procedures, or like vitamins or supplements, memberships to gyms, those are not expenses. Now, I am also going to provide you with a tracking Excel spreadsheet that is going to cover all of these categories, so that you can capture all of these categories that are required by the IRS in case of an audit. So that spreadsheet that you will have for expenses, you have to note the date that the service was paid. If an expense is paid during the year, it is deductible. If it's billed on a previous year and it's paid on the next year, it is deductible the next year. So it's always deductible at the year that the expense was paid. Now you have to also identify the patient name. And this is important if you have more than one disabled child. You have to have the provider name and identifying information for that provider. You should note in that template or in that tracking, what kind of service, what category of services or medical categories was received, the amount that was paid, if you got reimbursement for that, or if you expect a reimbursement for it, what is the medical purpose of that treatment, and where do you have the receipt for that expense? If it's in an iCloud drive, if it's a physical folder, where is it? Is it an email archive? And then gonna show you a little bit of this spreadsheet if I can. Can you tell me if you see the
Yes.
spreadsheet?
Yep.
Okay. So in the spreadsheet is going to have 4 tabs, and one is it's going to be a very detailed instruction sheet. Okay. And I added like, what is the 2025 medical like mileage rate, and what is the 2026 one? That changes per year, so you can change it. Then you're going to have that instruction sheet, tab. You're going to have the expense log, which cover all those 8 pillars that I told you about. And you're also going to have a mileage log here, and you can change this number right here, and then it will do the calculations for you in the mileage below, on the table below. And then you have an annual summary here that talks about, it categorizes everything and tells you what is it that is deductible for you for the year. Now I am switching back to the presentation, and then so key takeaways for you is um, number one, disability removes the age cap for dependency. Um, disability, the second one, disability removes the age cap for earned income credit as well. And track every medical dollar with reimbursement detail for you. So that you have this consistent tracking for your expenses. And in the case of an audit, that you have everything, you know where everything is in that case. Now, everything that I covered today is general tax federal rules. It is not advice for your specific situation, and the applications of these rules depend on facts that, you know, I might not have in your particular case. So also, all the dollar figures are change annually. So you need to verify your current year thresholds before relying on any numbers in this presentation. And if anything, you know, I know we're gonna open up for questions. But if you have a personal question, business question, or financial situation that you might like to discuss, like, this is my information and you can reach out to me. You can follow us also on social media, and you can reach out to Janice as well, to, you know, she can get us in touch or get you in touch with other professionals that can help you navigate your specific questions or needs. And, you know, I am open now to take questions if there are any. There's a lot, it was a lot of information, so I know that you might some. Janice, back to you. Thank you so much.
Yeah, absolutely. I believe that if people want to unmute and ask any questions, they can do that. Does anybody have any questions?
I have a quick one. With respect to your takeaway number 3, is there in cases where, you know, the mother and father have divorced and the primary amount of time is spent with mother, is that who should be pursuing the that medical reimbursement type of thing, like wherever the primary placement is, I guess?
Yeah, where the primary placement is.
Okay.
Yes.
Okay. Great. Thank you.
Yep.
Anybody else have any questions? Okay, well, I believe that concludes this evening's webinar. Again, I'll send out the link and a survey to everybody. And of course, you can always go to Morgan's with an SCC for caringconnection.org, where we have on our webinar page, this webinar will be there and any other of our pre-existing ones, and then a listing of all the upcoming webinars that we have. If you do see any glitches or anything, we are in the process of redesigning our website. So feel free to reach out to me directly if you have any questions or anything. Thank you all very much for attending this evening, and we appreciate you.